Let me ask you something. If someone handed you a machine and that machine took $200 a month from you and after 40 years gave you back $1.2 million, would you use it? Of course you would. That's a no-brainer. That machine exists. It's called investing. And the crazy part? Most people never use it. Not because they can't, but because nobody ever sat down and explained it to them properly. Until today. In the next 20 minutes, I'm going to walk you through everything you need to know about investing as a complete beginner. What it is, why it works, how to actually start, what to buy, what to avoid, and the exact mistakes that keep most people broke. No jargon, no fluff, just the truth. Let's get into it. I want to tell you about two brothers. Call them Marcus and Jordan. Same family, same neighborhood, same income growing up. At 22, Marcus starts putting $200 a month into an index fund every single month. He does this for 10 years, then stops completely at 32. Never invests another dollar after that. Jordan watches his brother do this and thinks, I'll start later. I want to enjoy my money now. So he waits. At 32, he finally starts investing $200 a month, and he never stops. He invests every month for the next 30 years, straight until he's 62. So Marcus invested for 10 years. Jordan invested for 30 years. Jordan put in 3 times as much money and 3 times as many years of effort. Who do you think ends up with more money? Marcus. By a lot. Marcus ends up with about $1.2 million. Jordan ends up with around $450,000. How is that possible? One word, compound interest, and we're going to get deep into that. But first, let's make sure you actually understand what investing is, because most people have it wrong. Here's something schools never taught you. Saving money is not enough. In fact, just saving money, doing nothing else, is slowly making you poorer. Here's why. Inflation. Every year, on average, prices rise about 3%. Groceries, rent, gas. Everything costs more year after year. That's just how economies work. Now look at your savings account. The average savings account in America pays about 0.5% interest per year. Some pay a little more, some pay less. So you're earning 0.5%. Inflation is eating 3%. Every year, you're losing about 2.5% of your purchasing power. Let's put real numbers on this. You save $10,000 today, you put it in a standard savings account and leave it for 20 years. At 0.5% interest, you end up with about $11,000. Sounds fine, right? But in 20 years, because of inflation, that $11,000 only buys what $6,700 buys today. You lost almost $3,000 in real value, while doing nothing, while being responsible, while saving. That's the cruel irony of not investing. You feel like you're being smart, but you're slowly falling behind. Investing is the solution. Investing is how your money grows faster than inflation. It's how you stop treading water and actually build wealth. Okay, let's define this properly. Investing means putting your money into something that has a chance to grow over time. You're not spending it, you're not just saving it, you're putting it to work. The most common thing people invest in is stocks. So what's a stock? A stock is a tiny piece of ownership in a company. When you buy 1 share of Apple, you literally own a tiny fraction of Apple. You're a shareholder. When Apple makes money and grows, your share grows in value too. Now, here's where beginners go wrong. They think investing means picking the right stocks. Trying to find the next Apple or Amazon before anyone else does? That's not investing, that's gambling. And even professional fund managers, people who do this full-time with decades of experience, fail to beat the market most years. Studies show over 90% of actively managed funds underperform the market over 15 years. So what do you do instead? You buy the whole market. That's it. Instead of picking one stock and hoping it wins, you buy a tiny piece of every major company all at once. When the overall economy grows, you grow. This is done through something called an index fund, and this is your best friend as a beginner investor. An index fund is a collection of stocks bundled together that tracks a specific market index. The most famous index is the S&P 500, which is just the 500 biggest publicly traded companies in America. When you buy a share of VOO, which is Vanguard's S&P 500 index fund, you're buying a tiny piece of all 500 of those companies at once. Apple, Microsoft, Amazon, Google, Tesla, Johnson & Johnson, all of them, in one purchase. If one company tanks, no big deal. You own 499 others. If the overall economy grows, and over every 20-year period in American history it has, your investment grows too. Simple, diversified, proven. That's why index funds are what Warren Buffett recommends for everyday people. And that's what we're going to use. Before you invest a single dollar, I need you to do two things first. And first, build a starter emergency fund. At minimum $500 to $1,000 in a separate savings account. Why? Because if your car breaks down or you lose your job and you have no cash, you'll be forced to pull your investments out. Possibly at the worst time, possibly at a loss. Your emergency fund prevents that. Second, if you have high interest debt above 15%, like credit card debt, pay that off before investing. No investment in history has reliably returned 20% per year. Paying off a 20% credit card is literally a guaranteed 20% return. Nothing beats that. Once those two are handled, you're ready to invest. This is the most important step and most people skip it or don't even know it exists. A 401k is a retirement account your employer offers. The key word here is match. Many employers will match your contributions up to a certain percentage, like 3% or 5% of your salary. So if you earn $50,000 a year and your employer matches 3%, that means if you put in $1,500 a year, your employer adds another $1,500 for free. That's an instant 100% return before the market does anything. You will never find a better guaranteed return than that, ever. Take the full match, every time, no exceptions. After your 401k match, the next best account for most beginners is a Roth IRA. Here's why it's special. You put money in after taxes. It grows completely tax-free. And when you withdraw it in retirement, you pay zero taxes. None. Think about that. You invest $200 a month for 40 years and it grows to $1.2 million. With a Roth IRA, all of that growth is completely tax-free. The IRS gets nothing. In 2026, you can contribute up to $7,000 per year to a Roth IRA. That's about $583 a month. You can open one at Fidelity, Schwab, or Vanguard in about 10 minutes. All three are free. Link is in the description. If you've maxed your Roth IRA and still have money to invest, open a regular taxable brokerage account. Fidelity and Schwab are the best for beginners. Robinhood works too if you want something simpler on your phone. These accounts have no contribution limits. You can put in as much as you want whenever you want. The only difference from a Roth IRA is that you'll pay taxes on your gains when you sell. Inside whatever account you just opened, you're going to buy one of two things. VOO Vanguard S&P 500 ETF tracks the 500 biggest US companies, expense ratio of 0.03%, meaning it costs you basically nothing to own. VTI Vanguard, total stock market. ETF tracks the entire US stock market, over 3,500 companies, even more diversified than VOO. Honestly, either one is fine. Both have performed almost identically over the long term. Just pick one and go. Search the ticker symbol in your brokerage account. Hit buy, done. You're now an investor. Set up automatic investments on the same day every month. Pick your amount, $50, $100, $200, whatever you can afford. Set it and forget it. This removes emotion from the equation. You stop trying to time the market. You stop panicking when stocks drop. You just keep buying automatically every single month through ups and downs. This strategy, investing a fixed amount regularly, regardless of market conditions, is called dollar cost averaging. And it's the single most effective strategy for long-term wealth building, bar none. I'm gonna wait for the market to crash and then buy. I hear this all the time. It sounds smart. It's not. Nobody, and I mean nobody, can consistently predict when markets go up or down. Not hedge funds, not Wall Street banks, not your uncle who watches CNBC every morning. Studies show that if you missed just the 10 best trading days of the S&P 500 over the last 30 years, your returns would be cut in half. Those best days almost always happen right after the worst days, when people are most scared to buy. Timing the market beats timing the market, always. Markets drop. That's not a bug, it's a feature. The S&P 500 drops 10% or more in about 1 out of every 3 years. It drops 20% or more roughly every 7 years on average. But here's the thing. Every time in history, the market has recovered and gone on to hit new all-time highs. When your portfolio drops 20% and you feel sick, that's not a warning sign. That's a sale. Everything you own just got 20% cheaper. The right move is to buy more, not sell. Crypto, meme stocks, AI penny stocks, whatever the internet is hyping this week, by the time you hear about a hot stock on social media, the people who made money on it already sold. You're buying their exit. You're the last one in. Boring index funds beat exciting individual stocks over 90% of the time over 15-year periods. The boring path is the wealthy path. I'll start when I have $1,000 or $5,000 or when I get that raise. The best time to start is with whatever you have right now, even $10, even $25. The habit matters more than the amount at the start. Get in the game, then scale up as your income grows. Waiting one extra year at 22 costs you more than $100,000 in retirement wealth. That's not an exaggeration. That's the math of compound interest. Checking daily is the fastest way to make bad decisions. Markets move up and down constantly in the short term. It's noise. Ignore it. Set up your automatic investments. Check your portfolio once a quarter at most. Then go live your life. That's actually the strategy. Benign, neglect, let it grow. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, it's true. Here's how it works. You invest $1,000. It earns 10% in year one. Now you have $1,100. Year two, you don't earn 10% on $1,000. You earn 10% on $1,100. So now you have $1,210. Year three, 10% on $1,210. You have $1,331.
Yeah.
You're not just earning interest. You're earning interest on your interest. Every year the base gets bigger. Every year the growth accelerates. After 10 years, that $1,000 becomes $2,594. After 20 years, $6,727. After 30 years, $17,449. After 40 years, $45,259. You put in $1,000 once. You ended up with $45,259. You didn't work for that extra $44,000. Time worked for it. Now let's do this with monthly contributions. $100 a month, 10% average annual return, starting at 22. After 10 years, $20,655. You put in $12,000. After 20 years, $76,570. You put in $24,000. After 30 years, $226,049. You put in $36,000. After 40 years, $637,678. You put in $48,000. You turned $48,000 into $637,000. The market gave you nearly $600,000 for free, just for staying in the game. Double that to $200 a month and you're looking at $1.2 million. From $200 a month, that's less than most people spend on food delivery. Once you've got the basics locked in, here are a few things to explore next. Dividend investing. Some stocks and funds pay you cash regularly just for owning them. These are called dividends. As your portfolio grows, you can start building a stream of passive income from dividends alone. I'll do a full video on this, subscribe so you don't miss it. Real estate. Property is another powerful wealth builder. You don't need to be a landlord either. REITs let you invest in real estate through the stock market with as little as $10. Increasing your contributions over time. Every time you get a raise, increase your monthly investment amount, even by $25. This is called lifestyle inflation prevention, and it's one of the most powerful wealth building habits you can build. Alright, let's recap everything we covered today. Saving alone isn't enough. Inflation eats your money slowly. Investing is how you beat it. Don't pick individual stocks. Buy index funds like VOO or VTI and own the whole market. Start with your 401k match if you have one. Free money first always. Then open a Roth IRA, then a brokerage account. Invest automatically every month, never stop. Never panic sell. Never try to time the market. And start now. Not when you have more money. Not after the next crash. Now. With whatever you have. Because every month you wait is compounding, working against you instead of for you. The machine I told you about at the start of this video, it's real. It's available to everyone. And it doesn't care how much money you make, where you grew up, or what you know right now. It just needs one thing from you. Time. Give it time, and it'll give you $1 million. If this video helped you, subscribe. I drop a new video every single week breaking down money exactly like this. No fluff, no paid courses, just the truth. And drop a comment. What's one thing from this video that you're going to do this week? I read every single comment and I'll reply to as many as I can. See you in the next one.